Anyway, you guys are all on. Thanks for joining. We'll keep this we'll try to end right at 6. I hope everybody got all the teasers because this man over here, Travis, is amazing. Okay. He jumped on the call. We had the Better Life Virtual Summit. I don't know if anybody popped on for that. It was super cool. And Travis was on there and he talked about sober living homes and stuff like that. And I was super intrigued by that, and so was my wife. So we've been talking with Travis, and we're going to look into that as well. But what's so cool about that is talking with Travis, that's how he kind of started raising capital, right? And got to the point where he's at now, where he's got quite a few homes throughout the US, over $30 million. Correct me if I'm wrong there, Travis. And you're managing assets throughout the US, right?
Yep.
Yeah. So just a cool deal. And I was like, man, how awesome. We just connected through Circle, and he was asking about it. And I'm like, oh my gosh, can we have you on this call? Because I think this is exactly from a lot of you people posted on our or my what do you call it, survey thing I did or whatever, asking like what people are looking for and in the Raising Private Capital group. And I feel like this is going to hit a lot of that. So without further ado, we'll get started. Oh, by the way, too, I also posted another thing on there, and everybody's bashing me. I know my wife's better at this whole talking thing than I am. So, yeah. Anyway, but I'm not upset by it. You guys go ahead and bash me. I think I got one vote. I was just looking at me right now. I got one vote. So thank you, whoever that was that voted for me. That means a lot. Anyway, all right, Travis. So let's start out with this. Let's talk about how this is my big thing. Okay, so in this venture, and as you guys know, most of us on here are rookies, myself included, looking to land my first deal through raising money. So I think a very intriguing thing for all of us is like, how did you start? How did this all come about? Talk about your past, where you came from, how you got into real estate, and then you were like, wait, I need to raise money? How do I go about that? So just kind of give us a brief synopsis of how it all kind of started.
Sure. Yeah. I'll try to be brief about it, but I grew up in construction. My father's a general contractor, and so I grew up swinging a hammer and kind of knowing the ins and outs of properties, and kind of had in my head that I wanted to get into real estate at some point. But after college, I was in sales, driving around Los Angeles and listened to Rich Dad Poor Dad on tape, like probably a lot of people have. And so I had in my mind that I wanted to buy real estate and get into that. And so my started in 2016, started by buying a short sale that my wife and I completely gutted and did all the work ourselves and lived in for 2 years. And then we basically bird that whole place, and we still own it. We've gotten more money out of it than we've put into it, and it cash flows, $400 or $500 a month. And we've gained $500,000 in equity since we bought it. We did that a couple times. We're up in Washington State now. We moved up here in 2018, and I had a tech company, which I was doing pretty well with, and was able to cash out on some equity. I knew I wanted to start investing in real estate, and in my mind at the time, I felt like I could only invest in real estate where I could drive to and I could touch it, and it was, in my local market. And so I started just reaching out. I was doing a ton of work here on our house that we've got here, and I was kind of asking around to my subs and everything, like, who are some investors that in the area, who's doing well, with flips or other investments. And so I started networking, and I found my now partner Jared, who was doing flips and some other investments in the area. And I kind of told him like, hey, I think the market's kind of high right now. But I want to start getting reps in. So if you could just send me, deals that you're looking at, I would love to just get eyes on it and know what a good deal looks like. And within about 6 months, we kind of hung out, and he became a friend of mine, and happened to meet up one day when he was looking at a house down the street from me, and asked him what he's working on. And he was going to go check out this house that was on the market, listed as it was 587. And he had heard that there's an organization that wants to rent it for 5 years at 5,800 a month. And he was going to go check it out and figure things out. And he didn't have the cash to take it down, but was going to still look at it. And I was like, well, I might be able to jump on that. let me go with you. And so we went and looked at it, did some quick due diligence. I ended up buying that house, but the way that my mind works is like, hey, this is really good. Like, let's try to poke holes at it. We tried poking holes at it as much as we could. And then I was like, let's figure out how to scale this. And so I told Jared, hey, I don't want to just buy this one house. I want to partner with you and I want to do this at scale. And so that led us to buying 10 houses in the first 6 months of getting started with that organization. And the way that we did that was we started off with my capital to buy the first house and part of the next couple houses, but we found ourselves with 6 houses under contract all at the same time. We had never bought a house in an LLC before. We had never used a DSCR loan at that time, and we were trying to navigate all of the kind of entry level stuff of owning real estate, through entities and DSCR loans and all of that. And we didn't ask all the questions that we needed to, and our lender ended up pulling the plug from us a week before closing on 6 houses. And so we had to we found a hard money lender who would close on all of them in a week, but we needed to put 35% down on all the houses. And at that time we had raised a little bit of money just from like family, like, hey, we'll pay you some good interest if you help us close on these properties. But we had to come up with like 300 grand really quick within a week. And so we just started asking around and we put it out there like, hey, we have to close on this. So, name your interest rate and we'll figure it out. And we ended up finding one lender who was a local builder, and he ended up putting down close to $300,000 at a 24% interest rate. And we were like, all right, like the numbers work. It still pencils. This sucks to pay 24%, but we're going to get rid of this loan as quickly as we can. And we were able to close on all those properties. We did some work on them. It actually worked out in our favor. This was before COVID, when you could do cash out refis up to 80%. And so we actually got more money out of some of these deals where we added value. But a lot of it had to do with just scrambling, and we paid whatever interest rate we needed to get the deal done, as long as the deal still worked. And so we did that for the first 10. We got those stabilized with long-term DSCR loans, and we kept some kind of friends and family money in as debt long-term that was at a much more reasonable interest rate. And so that worked for the first 10. COVID hit, and we kind of took a pullback to see what would happen. We just bought 10 houses and we're kind of flying at the seat of our pants. So we took a step back, and then things leveled out. Everything was working well. So we started buying again at the end of 2020. And we raised a fund. So we did I think Mauricio was on here at one point. So worked with Mauricio back in 2020. We set up a whole, 506c Reg D fund, raising money from accredited investors. So we did that, raised a couple $1 million, using our first 10 as like the case study for why that model worked. And we put together that fund structure. And from there, we went out and bought 26 houses over the next 18 months. And that worked well until early 2022, when housing prices started just going up like crazy and interest rates were climbing at the same time. And basically our rents couldn't keep up with our debt service costs on new purchases. And we were buying that fund assuming on average around 17% cash on cash. And when that got suppressed down to 10 to 12%, because of prices, it just didn't make sense for the fund to buy anymore. So we stopped buying through that vehicle. At that point, we did some cash out refis because with the appreciation, and used some of that capital to go buy some more. And then we eventually found a capital partner who's just one single high net worth individual who's willing to kind of fund all of our down payments on new properties. And so we've been buying dozens of properties with him just as a third partner in an entity at this point. Uh, and then yeah, so that's I'll pause there and you know answer some questions, but I can talk about the structure for the debt, the fund, and the partnership if that's helpful. But
Yeah. Yeah, dude, I totally think that would be super helpful because that was a question Paul had. If possible, can you share some general numbers? How much did you start with, and how much did you need in total? And that's crazy. So like when you and I also my big questions is like you started just prior to COVID, so you started 2019, right?
yep,
And then in that first year you bought, or first 10 months you bought, no, 6 months you bought 10 houses.
yep.
Okay, so it was like rock and roll, go crazy, and then how bad was COVID? And that was because you were not just buying in Washington State, right? Where you weren't you buying elsewhere?
Yeah, those 10 were in 4 different states.
Four different states. Okay,
Yep.
now did you have to kind of pivot once COVID hit, like where you were buying, like your buy box or your criteria where you were going? Did that kind of change things a little bit? Where you're like, okay, we can't buy in Washington or California or whatever? Did you have to move into different states at that point, or were you
Yeah,
looking at that?
so we bought a few of the first ones in Washington State, and at the time we were able to make the numbers work. With interest rates lower and housing prices being lower, now it's really hard for us to make the numbers work in Washington. And I mean, we bought a house in California during that time, in the Bay Area, and we paid 618 for it, put about 80 grand into making it adding an ADU. Now it's worth $1 million, but the rent on that one is 6,500 a month, and
Wow.
they probably can't increase that rent by very much. And we've had it for 5 years now. So, uh,
Wow.
but yeah, so we really, to answer your question, we went into more states after COVID. We actually, through that fund that we raised, we bought in 14 different states. So we kind of went wherever the housing was needed and the numbers penciled. Um, so we were buying for cash flow, not necessarily like targeting areas for higher appreciation. It was all about the cash on cash return. Obviously, we're going to vet out the market and make sure like it's not going to, the bottom's not going to fall out. It's not, doesn't have an anchor and an employer that's going to, if they go away, then housing prices are going to take a big pullback. They're stable markets, but we like the more linear markets rather than cyclical markets. I'm guessing where you're at in Florida, like, there's some higher volatility. In California, there's a lot more higher volatility. You're going to see higher appreciation on the properties. But you're also going to see, that volatility where you buy in the Midwest, you're buying a $300,000 house. It's most of the time it's going to go up at, 3 or 4% a year consistently. If you look at the last 100 years, as long as you have a long enough time horizon, you're just going to see kind of a steady rise.
Hmm.
So
Okay.
that's what we're
Um,
looking for.
okay, so can you talk a little bit more on that real quick? On that said, you're right. Like, how is that? How does that work? I guess you know what I mean. Just to kind of help me understand. I don't know if anybody else kind of what you
Just
just said there.
on the appreciation side of
Yeah,
the
yeah, yeah,
properties.
yeah.
Yeah, I mean, it all depends on the markets that you're investing in.
Right.
Some markets, if you look at like, I'm somewhat close to Seattle. I'm north of Seattle, but if you invest in Seattle right now, one, it's expensive. But two, like if you were to go buy a property right now, it's going to be extremely hard unless you're doing a lot of value add for it to actually cash flow. If you're putting in, 25% down or whatever, you're hoping that you can break even. And in nearly every case, you're not going to in Seattle, but you're kind of banking on that home being worth a lot more in 5 years, and rents will eventually catch up and you'll be able to cover that.
Mhm.
Whereas, if you go into the Midwest and you buy a house for 250,000, that house might be, 1.3 million in Seattle, but it's 250 in Illinois. And the rent on that is going to be, you even as a market rent, you might be able to buy it and get a couple $100 a month in cash flow. The difference is you're not going to see a huge jump in equity like you could in Seattle. So in my opinion, the more cyclical markets like Seattle and really just the coasts in general are more speculative than buying in the Midwest, the linear markets where it's hardworking people that are just going to continue to, it's going to rise with inflation, and you're not going to see a huge influx of people because the weather is amazing, and people want vacation houses or things like that. So
Right. Gotcha. That's a really good point. I love that, because you're right. I feel like that's just off topic on that with the Midwest and stuff like that. You're right. It's like the grinders, the people that just do their thing, grind it out, do their job, whatever. And then kind of on the coastlines and stuff like that, it's a little different clientele of people. So you have like the appreciations, I feel like, and then you have kind of like the cash flow areas. So all these homes, when you were buying them, and then we can get to some of these questions about like your general numbers and different things like that. I don't know if you can see that too in the, looks like
yeah,
people are putting it in
I
the,
just pulled it up. Yep.
cool. So when you first started this, and at this point, all the properties you're buying are all part of the sober living, right? It's all underneath that same umbrella. Okay. So you weren't just buying like single family homes just to do flips or something else. This was all strictly just under the sober living.
It was all sober living at that point. I got distracted throughout that time, and I bought some luxury sober vacation rentals out in Scottsdale, Paradise Valley area, and I've done flips. I still do some flips as well, but sober living has been just the most consistent way to kind of continue to invest and grow. So I keep coming back to that, and that's where I haven't deviated from. I've just gotten distracted over time doing other deals because I'm somewhat of a deal junkie.
Well, I was going to say, dude, you're talking to a group of people here that probably every single one of us understand distractions. We
Yeah.
all, at least for me too, I'm like onto this, and then I'm like, wait, what's this over here? I got to go check that out too. So yeah, no, I think we all get the distraction side. Okay, so as far as like general numbers, talking like from the, I don't know how much you want to get in detail here. I get like whatever you like to talk about is totally fine, dude. But it is helpful just to hear kind of like how that fund started, what did you do to raise, you know what I mean? Like who did you go
Yeah.
to, all that kind of stuff.
Yeah. So I guess I'll talk about the debt first, and then I can talk about the fund, and then even the partnership that we're doing now. But with debt, like I said early on, we did short-term debt at whatever interest rate we needed to make the deal work. We also didn't have a track record to like give us credibility. So we had the asset as the collateral and no track record. So it was like, somebody needs to get paid really well to take on that risk. Over time, I still have debt tied to some of my personal portfolio of sober living houses. But that debt, like now I pay 8% interest. So I have, a couple $1 million in equity that's built in that portfolio. I've got, quite a bit of cash flow that's coming in on a monthly basis. And so for somebody to come in and, want to be a debt investor for me, or if I'm talking to somebody like that wants to do long-term debt with me, I'd be like, hey, I can offer 8%, which isn't anything great, but for somebody who's looking for fixed income, they can either invest in T-bills right now and they can get 4.5%, 5%, which is, close to guaranteed. Or I can pay 8%. I've got a portfolio that's backing it with a bunch of equity. And I've got years of cash flow that's consistently paying every month that covers that cost. And if I take on, extra debt to go buy more properties, one, I'm adding more equity to that portfolio, and I'm adding more cash flow than what my new expense cost is. And so that's sort of the debt model. And I can grow that infinitely if I wanted to, because every time I take on more capital, I'm just making the whole position stronger. But I had to start with a base of properties. And to do that, it required my own capital to get into it. And then fortunately, I got some, strong gains in that portfolio through COVID and all of that. So does that make sense on kind of the debt side of things?
Yeah, and I feel like that's kind of like your pitch too, right? Because that's what you're going to other investors to raise capital, and you're saying like, this is what I got. I got a portfolio that backs it. I'm looking, you can do T-bills at 4 or 5% or whatever, and yeah, is it guaranteed? That's
Yeah.
whatever. But you know, but then like you said, like I can be around the 8% mark. Here's where I'm at. I have all this real estate and all of this stuff here to show them like this is a better thing to invest in, right? So if you're an investor and you have money to pass around, that's kind of like your pitch to them. Is that kind of the way you were going about it?
Yep. Yep. And I mean, I've got some investors that have just, they've got self-directed, IRA accounts, and they're like, I just don't want the volatility of it. They're getting closer to retirement age. 8% is great and it's consistent. They don't have to worry about any expenses or downside. And so that system works for them. That's one specific investor. Obviously, there's other investors who they want a little bit more risk, and so they're going to want equity. And that's probably where a lot of people in this group are looking to raise capital. There's a larger pool of people who want more exposure to the asset itself. And so the next step for us was the fund that we opened, and we raised a couple $1 million through there. It was all accredited investors. So when you do a accredited fund, it's easier in the sense that you're targeting people that have more money. They have over $1 million net worth outside of their primary residence, or they meet certain income levels. But you can also market it. You can do marketing for it. If you're doing non-accrediteds, usually you have a lower minimum. You're raising from more people, and you can't do any marketing for it. It has to be people that you've got direct connections to. And in my experience from raising a couple funds, the people who are putting in the smallest checks ask the most questions and are kind of the most needy in terms of investors. The ones who are writing the larger checks, where even if they give you 100 grand, but it's not, they're writing 100 grand checks to a bunch of different people. As long as you do what you say you're going to do, you'll never hear from them. They just collect their check and they're happy about it. So I liked the accredited model. It's also just a lot cleaner. But the structure of that fund, we basically did an 8% preferred return. So the money that comes in, they get an 8% return on that money first before any splits happen. The equity structure was split 50-50. So for me as the general partner or the manager, I got 50% of the equity upside, and they get 50% of the equity. But then we also did a different waterfall. And what a waterfall means is there's the preferred return. So as cash flow comes in, the first 8% on the money that's invested goes to investors. And then anything above that was split 60-40, 60% to the investors, 40% to me as the general partner. And so that was the general split from it. From there, you can also do like a asset management fee, and a common fee is 2% of assets. So that was kind of the general structure from that standpoint.
Okay, so the asset management fee, I'm working on that right now as we underwrite multifamily properties and stuff. And I've heard, between 2-4%, like whatever. But explain to everybody what that is, right? So from the way I understand it is like literally it's money that you get in your pocket for finding the deal or getting the deal done. Is that the correct way to say that?
So that sounds more like an acquisition fee.
Okay.
So an acquisition fee would be a one-time fee. So you raise $1 million and you go and deploy it. You get 2% one time for finding the property and deploying that. The asset management fee is ongoing. So it's 2% every year for the assets that you have under management, or that you've deployed. And that's really, most of the time, that's considered like the funds to keep the lights on, to run the books, to kind of do the day-to-day operations. And then any of the upside on the equity or the cash flow is like your profit for doing the work.
Okay, cool. So
sense.
that's an ongoing thing versus and so you're writing that in with like property management. Is that kind of correct? And then you're coming up with that number.
Yep.
Okay.
Yeah. So property management would be a different category. So there's property management, and sometimes, like in this case, we built a property management company for sober living houses, and
Mhm.
so we had to disclose that in the fund docs. Like, hey, we are also operating as the property management company, um, and we disclosed our fees and everything and all that. But that is different than the asset management fee.
Okay. Okay, gotcha. So I'll put you on the spot a little bit. So if I'm gonna be uh I have money and I'm coming to you, which I wish I did. I don't right now. I'm looking for it. But let's say I had money and I'm talking to you. The conversation comes up that you're in the sober living. This is what you do. You can invest with me. How are you going to pitch me? Like, what is your way to come to me and say, like, all right, hey, look, this is how I, and how do you go about that? Does it's just something like, obviously you had a fund where you're raising and syndicating and all that stuff, but because you can advertise then, right? So when you were on the street or just talking to people or whatever, how did that come about? And then how was it just an organic kind of conversation that happened and then you can explain it to them? Or do you just straight up walk up to them and say, you're getting 4% on your T-bills, I can get you 8% on this? How did you go about it?
Yeah, I mean it's different conversation for each. The debt has been mostly like just it's sort of come to me through like friends and family, and having conversations like this. Like, anyone listening, if you want 8% return on your money, reach out to me. Like,
Mm-hmm.
I've got a deal right now. But when I was raising the fund, my pitch is I'm going for accredited investors who are looking at a lot of different equity structures. Brandon's got ODC, and so he's got funds constantly coming out for, multifamily, self-storage, and these bigger projects where it's typically $100,000 minimum to buy in, which it was the same for our fund. But my pitch at the time was, there's a lot of funds out there for multifamily or these big projects where, hey, there's this one property in this single location that we have all these projected numbers on, but what if something goes wrong? Because you have that one big asset that is kind of anchoring the entire thing. Where for us, with single family homes and being in a diverse market, my pitch was, look, if something goes wrong with one asset, it doesn't affect it. It might bring down the average a little bit, but we can sell that property and we can move it into a different property, and we have different um, uh, exit strategies. From that standpoint, it's not all tied to one property or one market. And with COVID around that time, it was like people are moving and shuffling around with jobs and remote work and all of that. And so we kind of spread it out. We have a diverse portfolio of single family homes. And that was like our pitch. Like, you're getting exposure to a lot of different houses uh, instead of just one property.
Gotcha.
Yeah.
Makes sense. All right. See, and that's my thing too. And I'll be honest, man, that's like, as I've been learning, and again, like I hope everybody knows that I'm not some crazy capital raiser like Travis is here, and I'm learning to be there, and I will be there. But um, the steps I've been taking, I go to people. I feel like for me, it's more organic. I want to just like get to know someone, right? Like my buddy at church or different people, and just kind of build a relationship with them. And then if it gets into the conversation, I'll kind of tell them like, oh, what do you do? Yeah, I do this. Oh, really? Okay, I have some money to deploy or whatever, and then we get into that conversation. So for me, that's how it's been happening. And I feel like raising capital, and correct me if I'm wrong here, and anybody else, you guys can jump in. And again, if you guys have questions too, looks like Paul just asked another one. Travis, if you want to go through that and see what
Sure.
you can come up with there. But I feel like, and anybody can comment on this because I know where you all are at, but I know everybody in here has some real estate under their belt. So when you go out and raise capital, it's almost like buying your first real estate deal, right? As an investment, I'm not talking about our own home, obviously, but as an investment, it's nerve wracking. You don't know what you're getting into. It's a little bit sketchy. You're like, okay, how do I figure all this stuff out? Whatever. And it's kind of like, for me, it's like, uh, you just get kicked in the butt and get in and do it, right? I don't know if anybody else had that same experience, but like you can evaluate deals all day long. You can do all this different stuff. But the reality is at some point you just got to jump in and do it. Right. So for me, that's kind of like the raising private capital side too, is like, just like we can learn, we can go through these calls and stuff, which I still love doing because it's pulling the information from you and all these other contributors is mind blowing, a lot of it. But as in like the Better Life community and just getting to learn from a lot of these really like experts in their fields has been great. But like there's a point where it's like you can only learn so much, and then right, you just got to go do it. So for me, that's what's been happening lately is like, okay, I mean, I might not be as confident in the numbers and understanding all the different stuff out there to say, but there's a basic conversation you're having, and that is, I have a deal, I know what I'm doing. Do you want to jump on this deal or not? And here's what I'm looking at, and then you can figure a lot of that out, right? Is that right, Travis? Like you can figure out like the interest, what do you want to charge, all these kinds of things, and then the structure and stuff kind of comes as you learn from it. Is that kind of how you did your first deal, would you say too?
Yeah, I think the biggest thing is like knowing your numbers, and I'm pretty sure, Brandon talks a lot about that. And like, you need to know your numbers. You need to make sure you're factoring in your holding costs and not just making the numbers work on your spreadsheet. Cause there's a way that, you can get into it and you're like, well, like, maybe the tax won't go up when I, buy this property, but you need to factor in like, what are all of my hard costs on this property, and then what can I afford to pay an investor to bring in the capital in this. And if you're just starting out, you don't have a track record, like that investor this needs to be a win for them, because they're not trusting you, the operator, they're trusting in the deal. And when you run your numbers, if it works at 16% interest, or 2 points and 16%, and that's all you can get, go for it, as long as you feel very confident in your numbers. Because hey, if you go and pay an investor 2 points and 16% on their money, and you execute and deliver on that, they're going to come back to you and be like, hey, when do you want the next one? And then you tell them like, hey, that was great, but now it's 14% or it's 12. And that has happened to myself a number of times, where like that first guy who we paid 24%, he was like through the moon when we paid him back after 3 or 4 months. And he's like, do you want to do more? We're like, yeah, we do, at 12%.
That's awesome.
And
See, that's what I'm trying to say is like it's just like getting your first deal in real estate too. Like once you kind of get through the bumps and the bruises and all that stuff, right? And you start to see like, whoa, it made me money this month. Like, honey, look, we got a check, and it's legitimate. It's a real check, and I deposited and it worked. So that's the same kind of feeling, you guys. I get excited about that. I think it's awesome. That's the same feeling that you get, right? Like if you can go out and raise capital and get your first investor or whatever to buy in on the deal, well, now it's like, let's go. Because they're going to come back to you because they made money on the deal. They saw that they trust you. There's obviously a level of trust built there. And then from there, it's like, okay, what's the next one? And then maybe as you accumulate more deals, more and more people start reaching out to you because they heard Travis is doing this, right? So it just kind of continues to happen. But it's that first, and I feel like a lot of us here or there, it's that first step. How much knowledge do we need in order to make that step and go out and be confident and say, like, I'm ready to raise some capital. Let's go do this. So you're a perfect, I guess we'll say, statistic of that, right? Because within the 5 years you started, look where you're at. And I mean, that a lot of that started from there. And like you said, you have that mind to just like, I'm not just going to do one, I'm going to do multiple. I'm going to figure out a way to do that. You're a real estate junkie, like I think all of us are. So, and that's totally cool. I love that. So anyway, I just think that's amazing. So you guys, at this point, let's start asking some questions. If you guys want to post them in the comments, post them in the comments. If you're not shy and don't care, you can just raise your hand or shout out loud or whatever. I really don't. There's no perfect way to do this. I don't really give a rip. It's for you guys. It's for you guys to learn. So if you have questions, ask some questions. But Paul, the one question Paul asked here is, he said, much smaller scale, as I'm just trying to start. When I work on numbers, I'm in real estate finance. The cost in California to buy and the cost to refi with a DSCR loan is high, and I can't get rents to pencil without putting a huge amount of down payment and keeping the loan to value no higher than 60 to 65%. and
Yeah.
80% cash out refi would never be possible without a big monthly debt service loss. Everyone says to work in your backyard, but I'm finding that deals I see in SoCal are not going to cut it. I would love your advice on how to make something work. I don't have enough experience to get $1 million investor to trust me yet. I don't think. See, I feel like, Paul, you're saying something to yourself right there too. Don't doubt yourself. I don't think that's a good way to say that. I think you do. Obviously, especially being that you're working in the finance industry. But Travis, you want to add anything to that or comment on that?
Yeah, I mean that's sort of what we talked about with cyclical markets. I mean, I still have two properties in California, one in Carlsbad and San Diego, and I've had those for several years now. So they've worked in the long run. But yeah, in that market, you buy a new property, especially with current interest rates, like you're not going to be able to find a deal that's going to cash flow unless you do a ton of value add and you just get a screaming deal on the purchase price. It's going to be really hard to make that work. So you're sort of betting on the appreciation rather than the cash flow in that market. So that's the challenge. And in my opinion, it's more speculative than investing purely for cash flow. Which is why, I've gone to other states and I live in Washington now, but I don't buy properties in Washington anymore. I still have a couple here, but again, I've had those for several years, and those are sober living houses, and they work well. But I'm buying in the Midwest. I'm buying 2,000 plus square foot houses in the 2 to 400,000 range, and I can get them to cash flow at least 10 to 14% right now with 7.5% rates.
Okay. All right. Yeah. Cool. That's Paul, I hope that answers your question there, man.
And that's with 80%,
80%.
value. Yeah. So I'm
Wow.
putting 20% down on all my properties.
Wow. Yeah, that's legit. Um, so he said, so ongoing my backyard. Not, yeah.
So no,
Okay.
no go
No
in my
go.
backyard.
Yeah, no go. Yep. And then Cody Zucker, if you can go back, would you rather pitch more people? Ooh, that's a good one. At a preferable return and gather no's, or just get the less favorable terms and get more deals done to gain a track record or the track record?
So like doing the debt model versus the fund. Um, I think the way that I did it was probably the best path. I mean, it was hard getting the debt to work, and your reach is only so far, like in the beginning. You go to friends and family, how many people can you find, unless you've got a rich uncle or, rich people that who can put a lot of capital your way. You kind of run out of contacts that are willing to give you money at 8 or 10% for the long run. And then you're kind of also building it up, especially from the beginning. You don't have a whole lot of equity in it. So what happens when those investors call that loan? Do you have to sell a property? Are you, potentially upside down on it? I did that early on, but then now when I take on debt, like I put in a chunk of my own money already, but it's really like I could refinance a property and I could get somebody paid back, really quick. So on all of my debt loans now, I just do a 90-day call. So if they need the loan back, they give me notice. And I'll get their money back within 90 days, because I've got multiple ways to get that cash back uh, through refinance. In some cases, I'll have one property that's just all cash. So it's really easy for me to throw in a loan on that to pay back an investor. So there's options there, but doing the equity fund model when I was trying to scale, that got me a lot more access to the capital that we needed. I wouldn't have been able to raise a couple $1 million in debt. It went from, raising hundreds of thousands, 300,000, 400,000, in kind of the first round to, over 2 million in equity. And the equity is a lot easier pitch. So yeah.
And Absolutely makes sense. Absolutely. Okay. Megan, let's see. If you have forecasted out a rate of return and your deal is not going to produce that, do you take the funds out of your part of the deal to bring the investor up to the range you had forecasted? Or do you feel that the investor should carry the risk too?
It's a good question. I mean, the I sort of have the luxury with my model with sober living. I know one, I'm not trying to flip it, so I'm not speculating on the after repair value. I'm basing it off the cash flow. And so the variables on my side are I know what my rent is. I've already pre-negotiated a 3-year lease before I even close on the property. So my variables are the interest rate and tax, insurance, and I can get really close on those numbers. The other kind of unforeseen would be you close on a property, you didn't find something in the inspection, and now there's a $20,000 hit. Uh, that happens. I wouldn't take that out of my portion uh, and cover it with the investor. That's sort of some of the risk, and that's part of being an equity investor. If you invest in a fund and you're getting the upside for the equity, you also have to participate in the downside. If you're a debt investor, then that investor is going to get the debt no matter, they're going to get their interest no matter what. So if I lose money on the deal, I'm going to lose money on it, and they're going to get paid no matter what, even if I have to pull cash from a different deal to pay them off. That's how that would work. So you try to do your best to know the numbers. But if you're flipping the property and the market turns against you, it totally depends on the expectations with the investor and all of that. If you did something wrong on the deal, you didn't do proper due diligence, and you feel like you need to make the investor whole to maintain the relationship, I know that that can go a long way in preserving relationships. So that's sort of a, you know, how do you feel ethical wise and how the deal was negotiated, if that makes sense.
Nice. Thanks, man. That's a good one. You guys keep asking questions if you got them. Travis, something that's because you were saying right now you're raising money and you have a fund, right, or you have something, a project right now ready to rock, right?
Well, so right now, the way that I'm buying, one, we do kind of done for you options
Okay.
with our sober living houses. So we buy houses ourselves, but we also consult to help people buy their own sober living houses, where they own 100% of it. They're buying those properties. So that's one model. Our other model where we're buying properties, currently we have just one high net worth individual who funds all of our down payments. And that structure is just a partnership. Instead of going out and raising money from a bunch of investors, we have a partnership where that investor is just a member in the LLC. And then myself and my partner, Jared, are the managers of it. The investor gets 50% equity in the entity and all the properties. He gets an 8% preferred return on his money, and then everything above the 8% we split, and we get 50% of the upside on the equity for those properties. So, and then he just funds all of our down payments. So that's our current structure. I feel like it's a great deal. It's been a win-win for all of us involved in that. We've been doing it for a little over a year now, and we bought 28 houses in the last year under that structure. And so we like that for now. But the other one that I have, I just got approached from my fund that I raised in 2021. We are currently buying 3 more properties into that fund, and we haven't added any properties to that portfolio in the last couple of years, but we're doing a capital call in order to buy those 3 new properties. And one of the limited partners just approached me to ask if I'd be willing to buy him out because he wants to get liquid right now, and instead of putting money in. And the equity, I mean, I ran the equity's worth somewhere between 350 and 400,000. He put in 250 when he invested, and we've agreed at 280 that I'll buy out his position for 280. The cash flow, I mean, we've had this portfolio for years, so like very consistent on the income and it's going to go up, but it's between 10 and 11% cash on cash on the 280 if I buy him out. So right now I'm looking for I could liquidate some stuff and just buy them with my own cash, but I'd rather raise money at 8% for that 280 or close to that 280. And I know that I'm going to be getting 8 to 11%. So I'll make the 2 to 3% spread plus, potentially an extra 100 grand in equity that I'm gaining in a portfolio of 29 houses. So,
Wow. Okay.
yeah.
Wow. That's all right. So anybody have some cash and want to chat? I'm sure Travis will take your info because that's dang. If I had the cash, I'd probably be thinking that too. That's pretty good, man. Megan had another question, or I don't know if this was an add to the other one, but it said, what do you think are the key points that investors should look at when doing their own due diligence? I turned away an investor yesterday because I felt like their due diligence was so over the top that I didn't want to work with them. They wanted addresses of our whole portfolio and pictures.
So that brings up a really good point, Megan. Who you work with for investors is sometimes it's not just about the terms of the deal because investors can be a huge pain. And if they're starting off the relationship being, somewhat crazy with their questions and they're going to, you know, be overbearing, then that's probably a sign that you don't want to work with them. It sounds like you turned them away. So that's probably a good move. In some cases, I've found that certain investors, and this is where like it has to be like a mutual connection, or you've got some connection to the person. And there's people that are just very analytical. And once you get through their questions of due diligence, they're super easy to work with as long as you follow through on it. They're just trying to understand the deal. And so it's kind of like, is this an overbearing person, or are they just really trying to understand it? And, you can do a lot of education on what the deal is and how you got to your numbers and all of that. But if like they're going to be big brother and they're like, hey, I need to see every invoice, I need to see, all of this, it's just going to make your life a lot harder. So, yeah, absolutely. I mean, I think your question, and did I answer your question, Megan, or?
Yeah, that's good. I mean, is there a checklist or anything like that you're like, hey, this is what you should be looking for as an investor? I mean, I'm a Canadian investor, and there has just been a lot of devastation in the marketplace. People losing millions of dollars in the last year,
Yeah.
and so I want to make sure that my investors, when they're coming to me, that they're doing their own due diligence, but it's got to fall within a certain threshold. So, like I said, I didn't feel like this person was the best fit. Unfortunately, we turned them away. But is there like a certain checklist that you're like, hey, this is what you should look for, this, and this kind of thing?
Yeah, I mean, what you can do is you can be proactive on your end and present like a full package for the deal. Like, hey,
Mm-hmm.
this is the deal. These are the numbers. This is how I got to the numbers. This is our plan A, plan B, plan C,
Yep.
for our exit strategies. And, this is what is backing your money for collateral.
Mm-hmm.
And, in some cases, like, if somebody wanted to be overbearing with me with that kind of stuff, I'm like, either I'm not going to work with you, or I'm just going to be like, hey, you need to just be comfortable with it, or we're not going to work together, and just trust my experience. And I'll provide some documentation. I can give you addresses of my properties. I can show you the last statement to see how much the loans are and what my equity is in the portfolio, to back it, so you're not just taking my word for it. But beyond that, like here's the deal. Do you want it?
Yeah.
Are you good with it? And if not, then sort of move on. But I like a tool. If it's single family, we use a tool called Deal Check, that you can put in all your numbers, and it's a real simple kind of calculator, and then you can share it uh, with investors, and it looks clean. It's kind of a nice, easy way to present a deal, and it's got
Good
a
idea.
BRRRR calculator on there. It's got a rental calculator. So it's an easy tool to kind of put in your numbers, and then share all that with investors.
Okay. Thank you.
I like that, man. And you actually kind of spoke on that earlier too. And I don't know, Megan, if this is that type of investor, but Travis, you're saying earlier that there's this investors that usually dump in smaller amounts of cash and they want to know a lot more about what's going on. And you have the ones that are dumping in a larger amount of cash and they're just kind of like, whatever, just move it around. Pace Morby spoke on that a lot. He calls it like there's different sea animals. And it was like, there's the whale. I don't know if you heard that, Travis, but he's got like the whale that's just kind of like big and just moving through the water. They don't really care. Like just do what you got to do. And then there's like the dolphin that's like, hey, like I want to know what's going on, right? Or whatever, the shark. So I thought that was a good analogy to use with different types of investors. So
Yeah.
yeah. All right. And then let's see, David, we got time for one last question, and then we'll close here because I like to get you guys out of here on time. And actually I have to be at church because we're watching that Chosen. We're doing the series every Thursday. So David said, if that main investor handles the down payment, how do you handle homes that need a rehab budget and holding cost? Are you looking for move-in ready explicitly?
So two answers to that. One is for the sober living houses, we're stabilizing these as rentals. So if it's 75 grand for the down payment and all expenses on that, and then another 25,000 for rehab, then we're going to ask for 100 grand and just have it all covered by the investor in that structure. That's what I do now. Obviously, in the beginning, I brought a chunk of my own capital into that portfolio and then raised alongside of it. So it was like, hey, I've got skin in the game as well. And if you're starting out, that's probably, they're going to want to see some participation on your side from a financial standpoint. But if I'm doing a flip, I'm going to raise enough capital to do 100% of it financed with kind of a hard money lender. So we do some flips out in Georgia right now, and as long as the deal, I think it's like 75% of ARV, we can get 100% financed of the purchase plus the rehab, as long as we hit that. But if you guys know Tarl Yarber, he's my partner for that, and he's done 650 plus flips, and so we just use his private money guys, and they've done so many deals with him that it's really easy for them to kind of trust the deal. And we're also throwing a personal guarantee on it. So these guys know, like, hey, if the deal goes sideways, like we're going to pay it back. And we care a lot more about the relationship than making money off of one deal.
Yeah. And that goes back to that point we were talking about earlier about like you keep working with these investors or people that are putting into your fund and they can get to that point where Tarl has that connection and with you too. And I mean, that's what it's all about. So it's like building that trust with those people. See where it goes. Let's see, Paul. All right, we'll do this question, then we're going to close here. So super quick, and this might be a dumb question. No, don't be saying that. How do you pay investors 8%? Do you send them 0.667% interest monthly? Do you pay them all accrued interest at the end?
Yeah. So is it amortized monthly, or is it all at the end of the deal? So real quick, for the sober living houses, when I'm just doing long-term debt at 8%, I just set it up in my bank, honestly, and it's just a check that goes out automatically, or it's through ACH. And so it's amortized monthly. So I guess that's 0.667% every month. That's how I do it. I want to see it going out monthly so that I don't get hit with a big, interest payment at the end. And then it also comes in as I'm getting my monthly rent checks. I've got reserves in there, but it's like more gradual. For the flips, when we're using hard money, we do points and interest for those, and we'll hold the property for 3 to 6 months before we either refi or sell. And what we do is everything accrues until the end of the deal because there's no cash flow on it. So instead of coming out of pocket while we're in rehab, we're just accruing it all, and then at the refi or sell event, that's when we're getting all the liquidity. So that's when we're paying off those notes. So it depends. If it's a rental, it's amortized monthly. If it's a flip, then it's all paid at the end.
All pay. Okay, gotcha. Awesome, man. This is wow. Travis, I guess just tell us where we can find you. I know you're on BLT, but is there other ways that we can connect with you? You have Rooted Sober Living. Is it rootedsoberliving.com?
Yep.
Okay.
That's on there. Yeah, Paul, to answer your last question, interest only on those. And then if somebody wants, their debt back, then they just call the note and then pay back the full thing in 90 days. But yeah, I mean, I'm not super active on social media, but I'm at Travis T Gough on kind of all the channels. Yeah, rootedsoberliving.com. You can also shoot me a message on Better Life Tribe, and yeah, happy to connect or answer any further questions that you guys have. I'm also in the Raising Private Capital group as well. So if you guys have any questions there, I'm sure other people might have the same questions. So if you want to post more there, I'll try to answer them all.
Yeah, that's awesome, man. Travis, thank you seriously for jumping on. And also too, if you want to post some of your deals or what you have going on the group, there's a lot of people on there that'll invest, and you can chat with them too. So we just love to have you, man. It's so valuable, the info you're passing on. So we totally appreciate you. Y'all, thank you so much for jumping on the call. And hopefully y'all learned something really good today. And by the way, this will also be recorded, and I'll post it in our WhatsApp group. It'll be on my YouTube channel or whatever. So thanks again, guys. Travis, thank you so much, brother.
Thanks, Jeff. See
All
ya.
right, you guys have a good night. Bye.